It's no secret that Warren Buffett has discovered the golden ratio in the stock market. As arguably the greatest investor of all time, Warren Buffett has turned $12,000 into $100 billion in 65 years. So how did he do it? In this video, I dug through a compilation of his interviews and investor conferences over his investment career and compiled 5 important lessons. So, if you want to start investing in 2021, get ready and save this video for future reference because this is going to be an investing masterclass. If you're new to this channel, I like to turn complicated finance concepts into interesting animations. Let's get the most obvious but most commonly neglected lesson out of the way first.
And the question we get most frequently from people about you coming on is, what should they be buying right now? So if I say buy, you say?
I say basically hold. I mean, the idea that the European news or a slowdown in this or that or anything like that, that would not cause you, if you owned a good farm and had it run by a good tenant, you wouldn't sell it because somebody said, here's a news item, this is happening in Greece or something of the sort. If you owned an apartment house and you got to raise your rents a little, it was well located, and you had a good manager, you wouldn't dream of selling it. If you had a good business personally, the local McDonald's franchise, you wouldn't be thinking about buying or selling it every day. Now, when you own stocks, you own pieces of businesses, and they're wonderful businesses. You can pick the best businesses in the world. And to buy or sell on current news is just crazy. You're in a wonderful business. You got people running it for you. You know you're going to do well over 5 or 10 years. And to think news events should cause you to try and dance in and out of something that's a wonderful game is a terrible mistake. So get into a bunch of wonderful businesses and stay with them.
Just now, you watched Warren Buffett talk about a very common mistake among retail investors. For most investors, they focus too much on short-term trading. They check their phones every 5 minutes to see how their stocks are doing and try to react to all kinds of news. But Buffett here is saying if you want to make big money investing, you have to do it for the long run, just like a business owner. After all, buying a stock is fundamentally buying a part of a business. So how do long-term investments make more money than short-term trading? Well, let me tell you about an interesting phenomenon I discovered. A lot of friends around me prefer to invest in real estate rather than stocks because they've simply made more money on houses. But if you think about it, did they really? Is it because real estate appreciates faster than stocks? Let's look at the data for the last 100 years. On average, stocks have appreciated 2 to 3 times faster than real estate. So why do people make more money buying and selling houses? The first reason is, of course, that the mortgage adds leverage to our investment and helps us obtain extra returns. The second reason is that most people invest in a house for 10 to 20 years. Compared to the price you paid for a property 20 years ago, the house value has probably doubled or even tripled. This just shows that you have to invest for the long run. Try to think about trends that will happen in the next decade, like AI, electric cars, etc. For those who don't know if they are paying enough attention to the long term, I recommend doing a little test to find out. Take a look at your portfolio. Which investment is made based on weekly charts and which is based on daily charts? Building the habit of looking more often at weekly charts will help us stay away from short-term fluctuations.
We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you really got to grab them when they come, because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it. And every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company, you didn't even understand what they did or couldn't pronounce the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. It's easier now than ever because you can do it online. Just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one the rest of your life. You would think a long time before every investment decision, and you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to.
What Warren Buffett is referring to here is another common mistake among retail investors, which leads us to lesson number 2, over-diversification. Sure, we shouldn't put all our eggs in one basket, and it's important to diversify your investment portfolio to reduce risk exposure. But many of my friends have often bought dozens of stocks with only 1 or 2 shares of each. And worse, sometimes they don't even remember when and why they bought the positions. On the other hand, Warren Buffett isn't afraid of putting a lot of chips on one single company if he finds the company to be a good business with strong moats. For example, 47% of his portfolio, or about $120 billion, is invested in Apple only. Here, do another little test for yourself. Open your broker webpage and see if all your positions can be displayed on one page. If not, it might be a good time to take a look at each position and ask yourself if you really have a strong conviction about the company's long-term future. But what if you like diversification, you may ask? Well, in that case, I would recommend an index fund like SPY or VOO. If you are unfamiliar with this kind of index fund or ETF, please subscribe to our channel. We're making a video explaining what they are and what your investment strategy with index funds should be. Stay tuned.
Investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity, just huge opportunity. I mean, I've lived through roughly half, in an investing sense, about half that period. And I've had that long period of stagnation from 65 to 82, 17 years. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in 1970 put 100 and some % of their new money in stock because they were wild about stocks. Then they got a lot cheaper and they put a record low in, 9% of their net new money in 1978 when stocks were way cheaper. People behave very peculiarly in terms of the reactions because they're human beings and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful, and they'll continue to do so. And you will see things you won't believe in your lifetime and securities markets.
The third lesson is about Warren Buffett's famous saying that investors should be fearful when others are greedy and greedy when others are fearful. Easier said than done. This doesn't mean just buy the dip every time. What it's really about is to have independent thinking at all times and not be disturbed by emotions. When the market fluctuates, try to ask yourself what has changed. Are the company's fundamentals still there? This should help you stay calm in turbulent markets.
Unless you find the prices of a great company really offensive, if you feel you've identified it. And by definition, a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, it ain't a great company. I mean, so you really want to go along with the idea of something that if you were going to take a trip for 20 years, you wouldn't feel bad leaving the money in with no orders with your broker and no power of attorney or anything, and you just go on the trip and you come back and it's going to be a terribly strong company. I think it's better just to own them. I mean, we could attempt to buy and sell some of the things that we own that we think are fine businesses, but they're too hard to find. I mean, we found See's Candy in 1972, where we find here and there we get the opportunity to do something, but they're too hard to find. So to sit there and hope that you buy them in the throes of some panic, that you sort of take the attitude of a mortician, waiting for a flu epidemic or something. I mean, I'm not sure that will be a great technique. I think if you like the business and you like the person who's coming to you and the price sounds reasonable, and you really know the business, I think probably the thing to do is to take it and don't worry about how it's quoted. And it won't be quoted tomorrow or next week or next month. I think people's investment would be more intelligent if stocks were quoted about once a year, but it isn't going to happen that way. So.
Here is our fourth lesson. Many investors want to wait for the next market crush, and hopefully they can buy at the bottom. This definitely would work well in an ideal situation, but in reality, oftentimes the market has gone up a lot while they're waiting. A large portion of potential profit is left on the table. So why do people like to wait for a market crash? This has something to do with how we see risk. Many investors think the market is overvalued and the stock price will soon fall. Sure, this is one type of risk, but what they don't see is the other type of risk. If you should have made an investment and you didn't, the potential profit you would have made is another type of risk. That's why you hear the word FOMO, or fear of missing out, a lot. It's like in Texas Hold'em, you fold with strong hands.
Well, I've made a lot of mistakes. Biggest mistake, well, not the biggest, necessarily the biggest, but buying Berkshire Hathaway itself was a mistake because Berkshire was a lousy textile business. And I bought it very cheap. I'd been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, we'll say in 1949 or 50. It made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this, on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. It's disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price.
Many investors buy a company's stock simply because they think it's cheap compared to what it was. We like to do this because our brains have been trained by brands to react to discounts. When we see something is on sale, we think, oh, let's get it now, or otherwise it will go back to its original price. But the difference between a commodity and a business is that a commodity's value is static, but a business's value is dynamic. A company that we think is undervalued might eventually go bankrupt and be worth $0. Think about all the people that have bought Lehman Brothers shares when it was on its way down. Their investments are worth $0 today. But don't worry, we're not the only ones who make this kind of mistake. Warren Buffett himself has also fallen for this. In fact, that's why he bought Berkshire Hathaway, which was a textile manufacturing company. Luckily, Buffett's partner Charlie Munger gave him the idea that good businesses can be overvalued and stay overvalued for a long time. We also have a video coming up soon on Charlie Munger. There is a lot we can learn from this legendary investor too. So don't forget to subscribe to our channel. But don't leave just yet. In addition to these 5 experiences about investment, I've also prepared an additional and possibly the most important lesson for everyone. That is how Buffett defined success. Life is not just about making money, and we can learn more than just investment skills from Warren Buffett. I suggest you save this video for later, and in case you're in a bad mood when the stock market is down, come back and watch it again. If you liked today's video, I would also like to ask for a small favor, to like this video and send it to anyone you think might enjoy it. It means a lot to me for making good, informative videos. So let's take a look at the 6th lesson from Warren Buffett.
Well, I've said many times that if you get to be 65 or 70 and later, and the people that you want to have love you actually do love you, you're a success. I've never seen anybody that reaches that age. I mean, I'm not talking about somebody that's in extreme poverty or pain or something, but I've never seen anybody that, if they have a lot of people that love them, that is other than happy. And I've seen some very, very wealthy people that they give testimonial dinners to and name schools after and everything. And nobody loves them,